Delta. Delta measures how much an option's price moves when the underlying asset moves by 1 point. If a call option has a delta of 0.60, it means the option is expected to gain about 0.60 for every 1 point rise in the stock. For puts, delta is negative because they move in the opposite direction of the stock. Delta comes directly from the option pricing model, which estimates probabilities and expected movements. It also reflects the likelihood of the option finishing in the money. Traders watch delta to understand directional exposure and to manage how sensitive their position is to price changes. Gamma. Gamma measures how fast delta changes when the underlying asset moves. If delta tells you the speed, gamma tells you how quickly that speed is increasing or decreasing. Options that are close to the strike price usually have the highest gamma. That means their delta can shift rapidly with small market moves. Gamma becomes especially important near expiration when price reactions become sharper. Traders who manage large positions monitor gamma carefully because it can cause sudden changes in risk, even if the market moves only slightly. Theta. Theta represents time decay. It shows how much value an option loses as 1 day passes, assuming everything else stays the same. Options are wasting assets, and their time value slowly disappears as expiration approaches. Theta is usually negative for option buyers because time works against them. For option sellers, theta can work in their favor. The closer the option gets to expiration, the faster the time value erodes. This steady decay is one of the core forces behind options pricing. Vega. Vega measures how sensitive an option is to changes in implied volatility. Implied volatility reflects how much the market expects the asset to move in the future. When volatility rises, option prices generally increase because larger moves become more likely. Vega is higher for options with more time until expiration, since longer timeframes allow for bigger potential swings. Traders pay close attention to Vega around major events like earnings announcements, where volatility can shift quickly. Rho. Rho measures how much an option's price changes when interest rates change. While it is often smaller compared to delta or theta, it still matters, especially for longer-term options. Rising interest rates generally increase call option prices and decrease put option prices. This happens because higher rates affect the cost of carrying the underlying asset. In short-term trading, Rho may not play a large role, but in long-dated contracts, it becomes more noticeable.